So today we are going to be starting with revision for the second highest weighted topic of CFA Level 1, financial statement analysis. This entire topic has a few major chapters which we'll summarize using the mind maps. So at the beginning of FSA, you have your first reading, which is just an introduction where you have simple terms and definitions. What is financial reporting? What is the process or steps of financial statement analysis? And in those steps, what are the sources from which we will normally collect the data? So first chapter is a basic read. It doesn't require any mind maps. We'll start straight away with the mind map of inventory. This is the first major chapter that requires a mind map. For inventory, the discussion we split it into 4 parts. Firstly, we have some basic introduction. In this intro portion, we study the meaning of inventory. It is basically goods or material which are in possession of company. And this goods could be in any form. It could be in the form of raw material, could be in the form of finished goods, could also be in real world, simply packaging material or spare parts. So for the purpose of our syllabus, we only classify inventory as raw material, work in progress, finished goods. But in real world, packaging material, spare parts, and other such items are also clubbed together in inventory. Then we had a discussion about rules for valuation. Now over here, we'll simply write a number. In some cases, in the mind map, we put a number. The idea for this number is that when you look at this mind map, all 5 rules, you should be able to remember in your mind. Because what ends up happening is if we put all the 5 rules in the mind map itself, when you read the mind map, it gives a false sense of confidence that yes, you know all of it. But in exam, when you get questions like which of the following is most likely or least likely a relevant rule for valuation, over there, you should be able to recollect all the 5. So the 5 rules we had was purchase cost is relevant for valuation. Conversion cost, which is the money we spend to convert raw material into the finished goods, that is relevant. Any other expense is only relevant till base location. And that base location is basically the first point in time where you classify a good as it is. So if you are talking about finished goods, then the first point of time where we classify the goods as finished, that is referred to as its base location. So for each type of goods, the first point of time where you classify it or give it a proper classification, that is base location. Then fourth rule was waste. Waste is already included in the raw material cost. So we don't need to make any extra adjustments for waste, whether it is normal or abnormal. Normal waste is what we are expecting at the start of production process itself. And abnormal waste is what happens extra over and above my expectation. So waste is not relevant, whether it is normal or abnormal. And the final rule is regarding fixed cost. Fixed overheads, only the allocated portion is relevant. Allocated portion means that at the start of the year, when you take up a contract for some fixed cost, let's say I sign up a contract for 1 year factory on rent. So that rent that I'm committing to pay for 1 year, for that fixed cost, I will have some expectation of how much production or output I can take. So based on my expected output and my fixed cost, we find out an allocation rate. So only the allocated portion of fixed overhead is relevant. Clear? So when you look at the mind map, you see this number 5, all 5 rules should be back in your memory. If they are not, then you quickly go back to the class notes and you revisit the rules. The intro portion only had this much basic discussion. Then we had discussion for inventory management. For inventory management, we have FIFO method, LIFO, weighted average, and specific identification. Specific identification not really highlighted in your syllabus, but just for knowledge purposes, to be used in jewelry business or any other business which has unique items, where you have a lot of goods in stock, but each product is unique. So you'll have to identify which units are in stock, and each of them will have their own value to be calculated. Then we have FIFO, LIFO, weighted average. All three can be based on periodic or perpetual system. Periodic means that you will perform the calculation of stock and cost of goods sold only at the end of the time period. And perpetual means you will keep the calculations ongoing. Every time you make a sale, every time you do a transaction, you will calculate the cost of goods sold. Now, practically, FIFO is not affected by these two, because in FIFO, you always get same result. Whether you're using perpetual method or periodic method, FIFO will give exactly the same result at all times. That is also one of the reasons why IFRS doesn't bother with the word periodic or perpetual, because IFRS doesn't have LIFO method. LIFO is US GAAP only. Weighted average, although technically can be periodic or perpetual, it defeats the purpose of why we have weighted average. See, FIFO is on one extreme end of the calculation, where we assume that all the old goods will be sold first. So my latest purchased goods will be part of my stock. LIFO goes the exact other end, that my recent goods will be sold, so my oldest goods will be in stock. The whole idea of weighted average is to find a middle ground, that when I'm selling the goods, I'm not really keeping track of whether I'm selling my oldest goods or latest goods. So when I sell the goods, I'm selling all of them mixed together. That is the logic of weighted average. So weighted average was designed to basically create a middle ground between these two. Hence, if you create periodic or perpetual in weighted average, it defeats the purpose. So practically, for weighted average also, periodic perpetual is not very relevant. So now, for the purpose of mind map, what we can say is the periodic and perpetual classification is only relevant for LIFO. Right? Makes no difference in FIFO and not practically relevant for weighted average approach. Now, apart from this, we had a big discussion in this topic comparing FIFO method with LIFO method. Now, for the sake of this mind map, we'll draw it if prices are increasing. If the prices are falling, you are in a deflationary environment, then this entire table gets reversed. So closing stock, FIFO will be higher, LIFO will be lower, because FIFO values the closing stock at latest prices, the prices which exist close to the end of the year. So for that reason, closing stock will be higher in FIFO. Cost of goods sold have exact opposite relation, because formula for cost of goods sold is opening stock plus purchase minus closing stock. So as closing stock goes up, cost of goods sold will go. Profits have an inverse relation with cost. So where cost is low, profits will be high. Taxes are directly related with profits. Cash will be inversely related with taxes. If you're paying a lot of tax, the cash that is available with you will be comparatively less. So as long as this first column is clear logically, you don't need to cram this. This can be constructed in your mind in the exam. Take a little bit of time. For FSA, one advice that I will give to all the students is that don't try to rush through the questions, because most of the times when you practice questions of FSA, it feels like the questions are very theory oriented. But you have to understand what is being asked in theory format is actually based on your understanding of numericals. You can easily get a question where a company is using FIFO in an inflationary environment and they plan to shift to LIFO method. What would be the impact on, let's say, their current ratio? In this question, without giving you any numbers, Institute is checking your knowledge of inventory, FIFO, LIFO method, inflation also, and the ratios as well. So you have to understand, don't think of this as theoretical topics, so you try to cram this in. Link your understanding of numericals to this entire concept. In exam also, take 20 seconds extra to just think in a calm and composed manner. That will make sure that you get the answer right in the first attempt. Clear? Now, when you go through the books, inventory management and introduction, this is prerequisite. Your chapter starts from this section. Then, third section is LIFO reserve. Any company that follows US GAAP is required mandatorily to report LIFO reserve in the notes, not in financial statements, but in the notes. So LIFO reserve is simply difference of inventory as per FIFO method and LIFO method. The idea is, as an analyst, we don't have access to the individual transactions that the company is doing. So there is no way for us to figure out when the gap in inventory is there because of operational reasons and when it is there due to reporting choices. So US GAAP says, to make sure that analysts are not misinterpreting the information, company should disclose this, because if company doesn't disclose this, then as an analyst, you will never be able to figure out this gap. You don't have access to transactions, you get financial statements. So company will report LIFO reserve. From this, we can find out impact on cost as negative change in LIFO reserve. Change is always closing minus opening. And change in profits will be positive change in LIFO reserve, 1 minus X. This is the basic concept of LIFO reserve, and how as an analyst you can use this single number to also find out how much gap a company's cost is showing and how much gap a company's profit will be showing. But beyond this, we also covered an important topic, LIFO liquidation. LIFO liquidation is simply reduction of LIFO reserve. Can happen due to two reasons. Price is falling. In this case, ignore it, because this is beyond the control of company. Company cannot control the inflation in the entire market. And second reason for this to happen is if my quantity is falling. Here, we don't mean quantity of your production, we mean quantity of goods you have in stock. So your stock, the volume of goods you have in stock, that is coming. This indicates artificially inflated profits. So here, as an analyst, you would adjust profits by amount of LIFO liquidation. So whatever LIFO liquidation is happening, we believe that that is artificially being transferred over to profits. Now, one very important thing to understand, is company doing any sort of manipulation here? Answer is no. Company is simply following the accounting standard. This is a byproduct of LIFO method. So over here, we can't say that company is trying to artificially inflate the profits. It is happening automatically as a result of this method. This you can think of as a problem or a flaw of LIFO method. So as an analyst, we are simply fixing it. It doesn't mean company is doing some manipulation. Company will continue to report with these profits, and there's nothing wrong in that also. Last section of this chapter is the reporting rules. Three reporting rules that you have to remember. Firstly, for IFRS, cost or NRV, whichever is lower. NRV is calculated as the realistic money you will get if you sell the goods. So selling price minus any selling cost and modification cost. Now over here, write up allowed till previous write down. So when you increase or decrease the value of inventory, it will show up in income statement as profit or loss. But the rule is you can only show profit as a recovery of previous loss. You cannot show profit as it is outright. It's not possible for value of inventory to go up and create profits. But if it has gone down in previous years, you can recover it. So write up is not actually profit. It is simply recovery of past losses. Then we have US GAAP. US GAAP says cost or market value. Market value in books is also sometimes written as replacement value. So replacement value is just another name for market value. Once again, whichever is lower. And
cover selling price, cost, modifications to your
yes,
NRV.
NRV. Now, market value further has a range. It can only be between NRV and NRV minus expected profit margin. So market value cannot be any number you can assume out of the blue. It has to be a number within a specified range. Now here, write up, not allowed. Now, an exception to both of these rules is if your inventory contains commodities, especially commodities with active markets, things like gold, crude oil, agricultural products, something that has its price available on the stock market. So if your inventory includes commodities, in that case, you report it on fair value. And what does fair value mean? It means market value as observed on the stock market. Here, write up, write down, unrestricted. So no restrictions on how much write up and write down a company can do. So this commodity is an exception of these two rules. For commodity, IFRS, US GAAP, both are on common grounds. So this covers our entire discussion of inventory. Any doubts or queries?
Sir, if we have replacement cost and NRV, we'll simply take replacement cost as market value.
Yes. Replacement cost means market value at all times.
Okay.
Sometimes if question doesn't have the word market value or replacement value, either is written, but fair value is given. In that case, fair value can be taken as market price or as selling price. So in lack of any information, fair value becomes your next best option.
Sir, why is write-up not allowed in the US GAAP?
It's just a set of rules. This rules is. All right.
So मार्केट वैल्यू में लाइक एक एनआरबी था, एक एनआरबी माइनस एक्सपेक्टेड प्रॉफिट्स था, तो इनमें से जो कम होगा उसी को कंसीडर करेंगे.
Your market value has to be within this range. Within this range. So maximum and minimum within the range. Now, second topic that we have is long-term assets. Long-term assets include two categories, tangible and intangible assets. As per the new standards, we don't use the word tangible. Instead of them, we use the word property, plant, and equipment. So entire discussion of this chapter can be broken into 6 sections. First, we have initial recognition. This is the largest section of this entire chapter because here you have a lot of variation for property, plant, equipment, and intangible assets. So firstly, if you acquire the asset, depending upon your method of acquiring the asset, you could either purchase the asset. If you purchase the asset, then transaction price becomes your value of asset. You could have some sort of business combination. Business combination simply means some sort of restructuring, merger, acquisition. In this case, fair value. You could acquire an asset in the form of some sort of exchange. Here also fair value. But you have a choice, fair value of asset you're giving in exchange or fair value of asset you are receiving. Whichever can be estimated more accurately, not more easily, more accurately. And fourth is lease. Lease is covered with long-term liabilities chapter. These are the rules if you have acquired the asset. Wherever in this mind map I'm not creating a separation, assume that rules for property, plant, equipment and intangible asset are same. So this is common whether you're acquiring a tangible asset or an intangible asset. Now from this point onwards, we get separation. You have self-constructed assets. For self-constructed assets, property, plant and equipment, all cost till asset finished. This is to be treated as capital work in progress. So this will be reported as a separate asset and balance sheet. The idea is for anyone who is studying the balance sheet of a company, property, plant and equipment are assets which you are using in business. They should be linked with the revenue or the income of the company. These are assets which are currently in the process of being created, which means they are creating zero earnings at the moment. So that is one reason why we separate them from my regular assets. That is why we create a different category so that a user knows this is not contributing anything to my revenue. This is currently under construction. It may contribute to revenue in future. No contributions as of now. Then we have intangible assets. For intangible, IFRS has a simple rule: research, expensed, development, capitalized. Expense means when you incur an expenditure, you transfer it to income statement in that particular time period itself. So only if I'm spending some money this year, that is simply an expense for this year. It will have no long-term effect whatsoever. The research means where you have not yet established feasibility. Basically, you're in the experimentation phase. I don't know if the project would actually work out. Development phase begins once you are sure about the feasibility. Feasibility doesn't mean profitability. It is possible in development also some projects could turn out to be loss-making. But the logic is, I know that the project has some viability in the real world. There is a market which will be catered by this asset. So IFRS says, so long as you're in the research phase, whatever money you're spending, expense, show it in income statement, and that's it. But once you enter development phase, here you will start capitalizing the asset. How do you capitalize? Intangible asset under development. So just like tangible asset is separated from those earning money, intangible assets also will be separated from regular intangible assets because they are earning money. This is currently earning no money. US GAAP has a different set of rules. US GAAP says research and development both to be expensed. This is the standard rule for US GAAP. Then because this rule is not very suitable for companies who are operating in the software space, because as per this rule, company like Google or Microsoft, their intellectual property will have zero value in their financial statements because all the money you're spending is simply an expense. You're not building an asset. So then US GAAP came up with a rule for software. Software for sale. This rule, same as IFRS. Research to be expensed, development to be capitalized. And then you had software for own use. Instead of using the word free, they decided to use the word own use, because problem is if you specify the word free in the actual set of rules and regulations, free word is not very easy to interpret. A lot of softwares have a trial period. At that point, it is free. So do you change the reporting based on the trial period or the actual paid period? So it creates a lot of confusion. So that is where we use the word software created for own use. So for this, research and development both are capitalized. And here also capitalized means reporting as intangible asset under development. Now, this is initial recognition for acquired asset, self-constructed asset. We also have a third type of asset, goodwill. Created yourself, softwares, patents, could even be something like an office building. So let's say you want to start a company, you are currently renting out some space. After a few successful years, you decided that I want to actually create a space where the entire structure should be designed as per our needs. So that would be self-constructed assets.
So what's after PPP in bracket cap WI?
This one you're saying?
Yeah.
Capital work in progress. This is capital work in progress. Then last asset that you can have is goodwill. Simple rule, self goodwill, not reported. Simple reason, there is no defined way of calculating value of goodwill. So accounting standard says a company can have goodwill. It's basically their reputation, their brand value in the market. But there's no way for any company to figure out what the monetary worth is of goodwill. So your own goodwill you will never report in the financial statements, but purchased can be reported. How do you purchase a goodwill? When you actually purchase an entire other business. So if you acquire a company, you automatically acquire their goodwill also. So over here, purchase consideration minus fair value of net assets. So how much assets you have received from the acquisition versus the money you paid for the acquisition. So we believe whatever extra you have paid must be because there is a hidden asset in the target company which they are not allowed to report. What is that hidden asset? Goodwill. So whichever company you're acquiring, they must have some goodwill, but it's not showing up in their financial statements. So accounting standard says when someone actually pays money for it, now we can say that the value is justified. So only when you purchase a business can the goodwill be valued. Otherwise, valuation of goodwill not possible. So this is the entire section for initial recognition of an asset.
Sir,
Yes.
sir, in our books, when we came for US GAAP intangible asset, it is written that for software for sale, until the technological feasibility is established, they are expensed. And for software for internal use, until it is probable that company will use it for its intended purpose, it is expensed.
So intended purpose concept or probable usage, that
Yes.
is a common concept in IFRS also, US GAAP also. The idea is you only report an asset if you're actually planning to use it. So sometimes an asset or a project you're working on could be in the development phase, but you don't plan to use for it. You're just simply seeing how far the project can go, and maybe you then shelf it. After a few years, the technology catches up or market is ready for a product like that. So a lot of products have had their initial development done, but now companies often wait for the right time to actually work further. So idea is if you're not planning to actually generate money from that asset, then even the development should not be showing up in the balance sheet. So that is a blanket rule for IFRS also, for US GAAP also.
Okay.
Okay, so जो आपने point लिखा जो company, if company does not intend to complete the asset, then it cannot be capitalized. ये दोनों उसके लिए.
Correct. Then, apart from initial recognition, we then had discussion of depreciation or amortization. Depreciation means allocation of cost over the life of asset. So over here we had methods: straight line method, WDV method, double declining balance, and units of production method. Apart from this, we also covered component-based depreciation. So just a basic understanding is fine, because in your syllabus, depreciation is a prerequisite topic. So there's very little chance of you getting just this question, but this is tested in other places where you have application of this concept. So within long-term assets itself, when we cover additional expenses, those calculations require depreciation. Similarly, in taxation, you can get questions which will require you to be comfortable with these. So depreciation not testable directly, but indirectly via other topics. Then we have additional expenses. Can be expensed, can be capitalized. Management choice. Completely choice of management, whether they wish to expense it or they wish to capitalize this money. So we had a lengthy discussion in the class when it makes sense to expense, when it makes sense to capitalize. But in real world, it is management choice. So for the purpose of exam, simply have this clarity. Apart from this, you should have a basic understanding that if you expense, all the expenditure is showing up in first year itself, so your income will be less. If you capitalize it, you create an asset and then depreciate it. So expense will happen gradually. So just understand how it will impact your assets in the balance sheet and your profits. Then we had a small concept, revaluation. Revaluation is a concept of IFRS only. Because IFRS allows a choice, assets can be reported on cost model. Cost model means historical cost minus depreciation. Or assets can be reported on fair value model. You do the valuation and you report it at the fair value every year. That fair value model is what we call revaluation. So over here, if asset value go up, then you report it in income statement if there are any previous losses which you have not recovered, or you report it in revaluation surplus. And if the value of asset is going down, then you first subtract it from revaluation surplus if any surplus is available. And then you report the remainder of the loss in income statement. Beyond this, one very critical topic is impairment, very likely to be tested. Impairment is a two-step process. First step is to check whether asset is impaired or not. And second step is to calculate the loss if the asset is impaired. So IFRS, first step, if carrying value is greater than recoverable value. Recoverable value is realistically how much money you will make from the asset. So it is higher of either you using the asset, value in use, or you selling the asset, NRV. So out of NRV or value in use, whichever is high, that is recoverable value. And then loss is carrying value minus recoverable. All right, mind map will only make sense if you remember the original discussion we have. Impairment is a two-step process. So over here, when I'm giving you numbers 1 and 2, this is step 1, step 2. Step 1 is to check if the asset is impaired. And step 2 is to calculate loss if the answer to first step is that yes, asset is impaired. Then US GAAP, carrying value greater than undiscounted cash flows. And if the asset is impaired, then it is carrying value minus fair value of the asset. So you use two different amounts in step 1 and step 2. And lastly, we had goodwill. For goodwill, step 1 is carrying value versus fair value. Step 2 is also carrying value minus fair value. The rule for goodwill is common in IFRS also and in US GAAP also. Now, apart from this, IFRS allows reversal of impairment loss. US GAAP does not. But when you read through books, there is one exception. If you classify an asset as available for sale. So once you're done using an asset, it is now simply held for you to sell it, scrap it. In that stage, even US GAAP will allow reversal. So US GAAP does not allow reversal of impairment so long as you are using the asset. Once you have stopped using it, it is available for sale. That is one exception. But as a general rule, reversal of loss only allowed in IFRS. And this is a common theme. You will see this theme in inventory also and here also. Last discussion we have of this chapter is derecognition. Here you can have removal of asset in different ways. You can actually sell it. Business combination is possible. Exchange is possible. Again, lease is possible. Or scrap is possible. In all the cases, we figure out profit and loss on derecognition of asset. So when you remove the asset, you compare the amount you get at removal with the value which was already showing up in your financial statement. So if I have a machine worth $2 million and once I'm done using it, I'm able to scrap it or sell it to some other party for, let's say, $2.5 million. I'll compare my existing value of 2 million versus how much money I get. If I'm getting extra, that is profit on derecognition. If I'm getting less, it is loss on derecognition. In this entire chapter, you only have differences for tangible and intangible assets in initial recognition. Rest, almost all of it is identical. And for US GAAP IFRS, you have differences, one in the self-constructed intangible assets, and second, in the impairment side of things. Revaluation as a whole is only US GAAP. So not too many differences between tangible and intangible assets. Any doubts or queries with this chapter?
So for US GAAP, under impairment, is reversal allowed or not?
Only in one exceptional case where you classify the asset as available for sale. Otherwise, in
Okay.
general, reversal not allowed.
Thank you.
Sir,
Yes.
what will be the effect of impairment on return on asset, return on equity, asset turnover?
Impairment will reduce the value of asset.
Yes.
So when you calculate return on asset or so on, you have numerator, you have denominator. So for ratio-based questions, one simple rule I will recommend is if you get a question which has impact on numerator also and denominator also, and let's say the impact is both are going down or both are going up, which means you need some numbers to actually be able to figure this out. So in that case, two possibilities are there. Either the question provides you with what the ratio was before. So let's say institute says return on asset was 20%. Then you had some impairment. Now what would be return on asset? So if you get a question like this where you don't have any numbers, but they give you a ratio before, easiest way to solve, take numerator as 10,000, denominator as 50. You can assume your own numbers. Then impairment will happen. Let's say impairment of 5,000 happened. Numerator will also go down by 5,000 because impairment is a loss. So your income will fall down. And this will also go down by 5,000. Now calculate the new ratio, compare it with 20%. You have your answer. So one possibility is question tells you what the ratio was before the change happened. Second possibility is institute doesn't tell you this. If this is not given, then one of the options will be cannot be determined. That is your answer. All right. If they are going in opposite direction, then it's very easy for us to find out without needing this. If numerator is increasing, denominator is falling, then ratio will increase. So problem is when both values are going in the same direction, if some previous value of ratio is given, based on that, assume numerator, assume denominator, and then solve it with your assumed numbers. You will always arrive at the right answer. Nimit. Clear?
Yes, sir. Yes.
All right. Tanish is asking a query that in the notes for IFRS, the notes say that development expense may be capitalized. That word maybe is used because of the sentence that we took in the class. That if it is not probable that you will use the asset, then you cannot capitalize it. So even if it's in development phase, the reason why notes use the word maybe is because there is always that blanket check you have to perform whether you will actually use the asset or not. All right. Continuing onwards. Next topic, taxes. Taxes is one of the easier topics. A company has to prepare statements as per accounting standards and as per tax law. First thing in the chapter, the basic terms should be clear. Over here, we use the word pre-tax income, tax expense. Assets value is called carrying value or book value. Over here, we use the words taxable income, tax payable, or tax base of an asset. So that basic terminology should be clear. Now, both of these are not same because they are created with very different objectives. Accounting standards are created with the objective of disclosing the information. Tax law is created with the objective of tax collection. So since the objective of both the statements is very different, as a result, same transaction can be reported in two different ways. So this difference could be of temporary nature, also known as timing difference, or it could be of permanent nature. Temporary or timing differences are the ones which will reverse automatically over time. For these, we create deferred tax asset or liability. Now, in our actual notes, we've written very detailed description that if your tax payable is more than tax expense, that will create some sort of a asset. If your tax payable is more than the tax expense, then you have paid more tax, so you will get a benefit later on that creates asset. Similarly, we've written note in the context of tax base of an asset and carrying value also. We've written note in the form of pre-tax income and taxable income also. So here I'm going to write a simple single version only. So over here logic is if your tax expense exceeds tax payable, then you create deferred tax liability. Right? If it's the other way around, you create asset and same logic. Notice one thing, this is as per accounting standards. And this is as per tax law. Same rule will be followed at all stages. Wherever your numbers as per tax law are lower, it will create deferred tax liability. As simple as that. Whether you want to write this rule in context of income or in context of asset value, rule will remain same. The accounting standard number, if it's higher than the number reported in tax, it will always create DTL. As simple as that. Now, DTL can create impact on income statement or balance sheet. The accumulation of all the DTL created in multiple years, that is reported in balance sheet. And how much extra you're creating in a single year, that is reported in income statement. So for this, we have a simple formula. Deferred tax liability is calculated as book value minus tax base multiplied by tax rate If future rates are available, we prefer to use those future rates. Now, apart from this, permanent differences. For permanent differences, create gap between effective and statutory tax rate. Effective tax rate is calculated as tax expense upon pre-tax income. So both the values from accounting standards itself. For this, disclosure required. So here you don't need to make any changes in the financial statements. You simply give a disclosure in the notes to accounts. Apart from this temporary and permanent differences, we also have an extra discussion comparing IFRS with US GAAP. IFRS says that deferred tax is always non-current. US GAAP says it can be current and not current. Either is possible. IFRS says you report on net basis, which means if you have asset liability both, you simply report a single net amount. US GAAP says you report asset separately, liability separately. Then future tax rate enacted or substantially enacted. US GAAP says future tax rate only enacted. If it is actually part of law, only then you can use the future tax rates, otherwise. And lastly, over here, we have concept called valuation allowance. If your deferred tax asset is falling, the reduction in the DTA is to be reported separately as valuation allowance. Why do we need this separate reporting? Because by default, if your asset or liability is falling, deferred, it indicates lack of future profits or future losses. The idea is whatever asset I have created, I've paid extra tax now, I will be able to claim its benefit in future. But that benefit will only be claimed if I actually have income in the future. If at the time of claiming the benefit, I don't have income, then the asset will lapse. So in IFRS, we don't have this rule because IFRS says you show asset liability on net basis. So if your asset is falling down, one of the very likely reasons is because liability is going up. So here, we simply report it on the net basis. But because you're showing asset liability separately, US GAAP says if your asset is going down, it means you are not expecting as much benefit as you were planning to get. In that case, highlight that separately so that people are aware that maybe there is a chance for lack of enough profits in the future to actually claim these benefits. Any doubts in the entire chapter?
So effective and statutory tax rate इसके बाद में अभी थोड़ा सा
देखो, statutory tax rate is what is written in the law. So every year we have the parliament session budget where tax rates are announced. So what is written in the Income Tax Act, that is statutory. But what you can infer from the financial statements of the company, that is called effective. So in income statement of a company, you may see pre-tax income 1 lakh, but the tax expense is only 20,000. So in the law, their tax rate may be 30%. But if you look at the annual report, it seems like they are only paying 20% tax. That is effective. So effective is what is visible in the financial statements, and statutory is what is written in law. Due to permanent differences, these two will appear to be different. So idea is, as a user, if you don't get any disclosure why it is happening, there is a chance you may misinterpret it. You may say that company might be doing some tax fraud. We don't want that to happen. So idea is, if company is paying a lesser tax than what is required by the legal rate, then they should disclose the reason for it to all the users so that they don't end up misinterpreting this information. So this will be a gap created due to permanent difference. So you give a note explaining what differences are actually there.
Sir, this future tax rate enacted, if you could just brief a little bit.
Enacted means it is actually passed in the parliament. So sometimes what happens is you have future tax rates or whatever changes you're planning to do in the tax regulations. You pass them in the budget itself. So generally budget is 1 year, but sometimes we pass some provisions which will take effect over next 5 years. Easy example for this would be 2014, when we got the current government for first time. They announced in their first budget that we will reduce corporate tax rate by 5% over 5 years. So it was 1% reduction every year. So in that case, you knew in the law itself what are the future rates. So if it is passed in the law, it is passed in the parliament, then we call it enacted. And if it has been just notified by a ministry or by any other reputed source, we are not talking about third party source, any official from tax department or any ministry has confirmed that even though it's not part of law, but we will give this benefit in next 3 years, 4 years. That is called substantially enacted.
Got it.
All right. Then we have topic of long-term liabilities. This is a smaller topic now that you only have to focus on two types of liabilities, lease and pension. Lease can be of two types, operating and financial. Financial lease, also referred to as capital lease. Financial lease is basically a loan arrangement disguised in the form of lease. So instead of calling your installments as interest or installment payments, you start calling them rental payments. So it is basically a loan only, but you're trying to structure it like a lease. That is called a financial lease. For this, we have conditions. All 5 conditions you should remember at all times. The idea is if any one of these 5 conditions is met in a lease contract, then the lease will be assumed to be financial lease. What are these 5 conditions? First, the life of asset is roughly same as the lease tenure. So entire life of asset, only the party who is signing the lease contract, they would be using the asset. Second, the value of asset today is approximately same as present value of all the rentals you will pay in the future. Third condition is that asset will automatically transfer over to the lessee. The ownership will transfer at the completion of the lease tenure. So ownership of asset will automatically transfer to lessee at the completion of the lease tenure. Fourth condition, lessee has an option to purchase the asset at expiry of the tenure at a discounted price. This discounted price will not be available to anyone else in the market, only to the lessee. And fifth and final condition, lessor has no use of the asset. The fifth condition, where lessor has no use of the asset, is primarily the reason for sales type lease. That is why the sales type lease is also given treatment same as financial lease. So 5 conditions important. From these conditions, reporting for lessee, present value of rentals will be reported as both liability and asset. Asset depreciated as per its own method. So apart from the fact that at start both have to be equal, once you report them, now it is up to the management how they want to report for asset. Liability will be increased by interest expense and reduced by rental paid. Lessor will only report PV of rentals as the lease asset. lease receivable, not the actual physical asset which was given on lease, but it will create a new asset specific to the lease, rent or lease payments receivable. So on this asset, every year, interest income will be added and rent received will be subtracted. Rent received will basically reduce the value of future benefits, hence the value of asset will fall. Now, interest will be reported in income statement. The actual cash amount that you're paying or receiving will be reported in cash flow statement, and the value of asset liability will show up in the balance sheet. For operating lease, the rule is very simple. Rent is expense for lessee, and rent is income for lessor. Asset remains with lessor. Simple rules. If asset remains with the lessor, he is the one who will also depreciate. But for operating lease, this is the rule if your lease is short term in nature. If you have long term operating lease, for long term operating lease, IFRS says same as financial lease. US GAAP says same as financial plus asset equals to liability every year. So every year the value of depreciation has to be equal to the amount by which your liability is going down. So over here, once you report them at the same amount at the start, then you have choice how you are reporting liability asset, two independent treatments. But over here, the logic is assets depreciation will always be equivalent to the reduction of liability, right? Apart from this, we get sales type lease. Sales type lease is when the lessor is either manufacturer or dealer of the asset. So in this case, same as financial lease, all the treatment same as financial lease, plus present value of rentals will also be reported as revenue at initial sale. So when you actually sell the product, at that point, present value will also be reported in the form of revenue. This is the entire rule set for lease. Now, throughout the lease, you'll notice something. Apart from this treatment of long-term operating lease, there is no real difference between IFRS and US GAAP. The rest of it is pretty much uniform. Then we have pension. Pension is defined contribution plan, defined benefit plan. Defined contribution plan, employer contributes, and employee manages. So investment decisions will be taken by the employee. In defined benefit plan, employer will manage all the decision making, all the investments. No headache for the employee. In defined benefit plan, because the employer is taking responsibility for payments which would be made all the way after retirement till death, here the employer is taking a future obligation. For that reason, this will create a liability. This liability is called projected benefit obligation, PBO. And it will create an asset also, because if you know that you will have to make some payments in 20, 30, 40 years, you will not wait for that time to come when you start making payments. You will start preparing for it today itself. So asset would be all of your investments reported as plan assets to indicate that these are investments made in reference to the pension plan. Now, this is going to be the impact on balance sheet. On income statement side of thing, we will have service cost, which is basically increase in liability every year as the employee completes more and more years of service. Any retrospective changes, past service cost. Any other interest, income or expense. And lastly, in OCI, actuarial gains and loss. This is as per IFRS. The only exception in US GAAP is past service cost is OCI as per US GAAP. In IFRS, this will be reported in income statement. In US GAAP, this also gets reported in OCI. Any doubts or queries with this? All right.
Sir, what is that PVO? That obligation?
Repeat again.
PVO, is that obligation?
Yes, projected benefit obligation. Because it is going to be based on expectation of what the salary may be at the time of retirement, growth, life expectancy. Hence, we call it projected obligation. Two more mind maps left. For ratio analysis and cash flow, there's nothing for us to discuss for revision purposes because our class notes were itself concise enough. And for all the students who struggle a bit with the questions of cash flow statement and ratios, you have to understand those two chapters will only be easy if you are comfortable in rest of FSA. Because cash flow statement and ratios, very few questions are possible where institute is checking your understanding of just those two chapters. Almost all the questions you get in those topics are linking that concept here. So cash flow statement and ratio, don't view it as a chapter. Think of it as an application of all the chapters. Clear? So any student who's struggling with those two chapters, make sure you are very comfortable with the rest of FSA. Income statement. We focus first on the format itself because if you understand the format, in your books, for every item which we'll write in the format, they've given a small paragraph. So you understand the format, all the things, that is your entire chapter revised. So we start with revenue from operations and other sources. Then we have expenses. Cost of goods sold, depreciation, employee expenses, any other expenses, giving us total of expenses. From here, we get to income from continuing operations. This is basically revenue minus expense. Then you have adjustments for discontinued operations. And you have adjustments for exceptional items. Discontinued operations are business operations which you no longer are supporting. So some business divisions or segments that you have shut down in the previous years, but you still have some contractual warranties or any other obligations to honor, due to which, even though you're not currently operating this business segment, you may still have some income or expense which relates to this business. So they will be reported as discontinued operations. And exceptional items are any items which are unusual, infrequent, or both, as per the nature of business. So what is unusual or infrequent will depend upon the actual nature of business. From this, we get pre-tax income. And then pre-tax income is adjusted for tax expense. Tax expense is broken down into current and deferred. Deferred, if positive, represents change in deferred tax liability. If it is change in deferred tax asset, this will be a negative number, giving us net income. From net income, dividends will be paid, and then the amount will be labeled as retained earnings transferred over to the balance sheet. The other half of the chapter is earnings per share. For EPS, we have firstly basic EPS. Earnings attributable to common shareholders upon weighted average number of shares. So first complication is this weighted average itself. For new issue or repurchase, transaction date will decide the weightage. So the date on which you did the issue or repurchase, that will decide the weightages. And for bonus, split, reverse split, date of original shares. Not the bonus, but the original shares on which bonus is given. That date will decide the weightages. So these are two rules to remember for weighted average calculation. Second is diluted EPS. Here, you should have clarity on the meaning. It is basically EPS calculated for potential securities. So securities which we expect will convert to common shares in the future. For those securities, when the conversion happens, it is very likely that the EPS will fall. So we don't want people to panic at that time. So we start disclosing that EPS will fall at conversion in advance itself. So two types of potential securities are possible: dilutive and anti-dilutive. Dilutive will reduce EPS at conversion. Anti-dilutive will increase the EPS at conversion. Diluted EPS is calculated for the combined effect of all dilutive securities that a company has. In your exam, maximum difficulty you can get is two securities. So you check them both individually, and then you combine the effect of all dilutive ones. As simple as that. Right? In real world, there are often 7, 8, 10 securities which are potential. So that is an accountant's headache, not relevant for us. Now, diluted EPS formula remains the same. The only thing is you will have to add the effect of dilution in denominator also and in numerator also. So what we refer to as dilution, this will depend on the security. For convertible bonds, you will save on interest, net of tax, number of shares will go up. For convertible preference share, you don't have to pay preference share, you save on that, number of shares go up. For stock options, no impact on income, number of shares may go up. So this is to be calculated on case-by-case basis. Now over here, one unique type of potential security was stock options, rights, or warrants. For these, you split into free part and paid part. Paid is assumed treasury, which means we assume these are not new shares, hence we ignore them in our calculations. Free part is added to denominator. So paid part completely ignored, free part will be added to denominator. So for most of the securities, you have to remember a rule that diluted EPS can never be more than basic. So in exam, if you get a question where mathematically diluted EPS is a higher number, you'll mark it equal to basic. So for most securities, even though question is of diluted EPS, you still need to calculate the basic to make sure you're not making a mistake. The only exception is stock options. Stock options, rights or warrants, all three, will always be dilutive in nature. So here you don't need to calculate basic for checking purposes. You can completely ignore that because for these, denominator will increase, numerator remains unchanged. So they will always reduce EPS. Tanish is asking if question says dividend paid to common shareholders, do we add it back? No. We are looking at net income. So if net income is already given, then net income minus preference dividend is our relevant number. So in net income, you don't need to add back common shareholders. From net income, we subtract the preference dividend. If retained earnings are given, then retained earnings plus the dividend to common shareholders, that could be the numerator. Clear? So no adjustment for common shareholders dividend if net income is given. Any other doubts or queries with this? All right. Last mind map that we need is for the topic balance sheet. For this chapter, the format is your entire revision, your entire mind. So balance sheet, we have equity. In equity, we report common share capital, preference share capital, retained earnings, other comprehensive income, treasury shares. Treasury shares or treasury stock are the shares that company has repurchased with the objective of reissuing them to some other investors. But we are in the transition period. I have repurchased, not yet reissued. And then we have minority interest. This is ownership of subsidiary which is held by some outside parties. So essentially, we have control over the subsidiary, but we don't have 100% ownership of the subsidiary. So the part of subsidiary which is controlled by parent, but not owned by parent, that is called minority interest. Then we have non-current liabilities. Non-current liabilities, long-term loan or bonds, deferred tax liability, lease liability, and any other amount that may be long-term will be reported. Then we have current liability. Accounts payable, notes payable. What is the difference? Notes payable is financial item. Short-term loans are called notes payable. This is our liability side. And then on the other hand, we have assets. So non-current assets. Property, plant and equipment. Intangible assets. Then capital work in progress. Intangible asset under development. Long-term investments. And deferred tax asset if we have a deferred tax asset in the first place. And then we have current assets, inventory, accounts receivable. Sometimes over here, we may also have short-term investments and cash equivalents. So for this chapter, if you look at all the items and you know the meaning of everything, then that is the entire chapter done. The only topic that had a little bit more detail here were the investments. For investments, you can report them in three ways. Amortized cost, fair value through P&L, fair value through OCI. These were names as per IFRS, and as per US GAAP, The names were held till maturity, trading, or available for sale. So for these, the IFRS names will also help you remember what the treatment used to be. All right. So for the purpose of revision, that pretty much wraps up our entire discussion of FSA. Cash flow statement ratios. Once again, I'm repeating for all the students because I know most of the queries that come, they come from those two topics only. You have to understand the queries of cash flow statement are often going to be resolved in other chapters. In cash flow statement, when you get a tricky question, you may need to involve the calculation of opening stock, closing stock, purchases to actually solve it. So approach those two chapters once you are comfortable with the rest of your syllabus. All right. If you think of cash flow statement and ratio as its own chapter, you will struggle with it. So don't think of it as a separate chapter. Think of it as application of the entire study of FSA. So for those two topics, the class notes are good enough because for cash flow statement, the entire note we take for indirect method, that is more than sufficient enough. And for ratios, our notes are basically a summation of all the formulas. So for those two chapters, we don't have any mind maps or any other references to take. So this, from my side, wraps up our discussion for today.